Hey everyone, it's Imran from Options Insight. So this is your macro options spotlight. All right, US stocks remained pretty cautious yesterday ahead of the FOMC today. Yields recovered from the initial fall on those Chinese rumors that ripped the Chinese market higher. Chinese stocks did manage to hold on to a decent bounce. You see FXI up 4% there on the day. K-Web was up even more. And then even European stocks kind of had a solid day, up nearly 1%. And they continue to trade quite well, actually. Now, commodities were up across the board. So you see gold, copper having a good day, up 3%, oil up 2%. So in general, commodity space liking the news around China, even though nothing was really confirmed. But just in general, sentiment in China has been so beaten up. We're getting a bit of a relief rally. We're getting some hope coming back. And in general, the commodity market tends to like that when there's some glimmer of hope in China. And, other than that, I do think commodities have got the potential to gain a bit of momentum here. We've been talking about banging the drum about oil for a little while. That's starting to show us good signs. And even copper, after being range bound for quite some time, copper is starting to move a bit more within its range and form a base here. And it may well be a case of breaking to the upside in the not too distant future. So keep an eye on that one. If we look at implied vols, pretty mixed. We're seeing vol dropping in the likes of Europe as it just can't move, still stuck on 11 realized. We saw vol a little bit softer in oil, but nothing to write home about. And then bonds are down as well in terms of volatility as those prices in bonds are kind of stabilizing a bit. Now, looking at the implied move on the S&P today, it's pricing in about 1.6% move today. And that does not sound overly expensive to me, given that it's FOMC day and given that the current average true range on the S&P, which is the 20-day average of the high to low on the S&P, including any overnight gaps, that is about 90 index points right now. And the straddle's priced at about 62 index points for today's expiry. So that seems a little bit cheap given that we've got the FOMC and you've got all types of strategists out there saying that market's either going to be up 3% or down 2%, or if it's a real disaster, it could be down 8%. Now, I don't think an 8% down day is very realistic, but the point is, even if you get through 2%, you're beating the 1.6% that's implied right now. So it doesn't seem overly expensive. So something to maybe have a look, see where that thing's pricing just before the FOMC comes out later today, but it might be a cheeky purchase. All right, looking at carry, European stocks continue to be the best carry. China continues to be the best long gamma position. 72 realized is pretty spectacular, but obviously that includes that big 10% down day. But we have had a strong bounce off that as well. CNH is obviously realizing pretty well at 15 as well, but that's all over the shop. But in general, FX has been the place to have some gamma. And then on the short gamma side, still seeing HYG as a bit of a sell. That's got 30% of carry embedded in that one. Skew-wise, skew in Europe and US having a very small bounce off those lows, but still in very low percentile ranks. Skew in China getting obliterated yesterday on the rally. That thing's just been crazy volatile, swinging around from 6 vols, 6.5 vols back down to 3 vols. I mean, that's pretty violent for that to happen in the matter of a day. So I just think those parameters in China vol surface are pretty unstable right now. We did see a big move down in oil skew. We've been talking about that. It's been happening quietly. The skew in oil has been compressing as people care less for puts and care more for calls. And we saw a big move down in the downside part of the surface yesterday. So it wasn't that calls went massively up on the day. We saw vol was down, at the money vol was down 40 basis points, but the skew was down hard. So the puts are actually getting smashed on oil. The calls are kind of hanging in there at the vols that they're at. And you're seeing this skew flip towards calls. So now we've got 25 delta risk reversal, actually 1 vol for calls over, which we haven't seen since May earlier this year. Okay, that's the summary for what I'm seeing across the cross-asset vol space. Okay, obviously we've talked about FOMC today. That's the big one. Now the move index is still up there, not far off its highs, where we've seen equity skew get obliterated down to multi-year lows. Equity skew down here is via this skew index. Now, this kind of shows you that the true fear in the stock market right now is fear of missing out, FOMO, or basically the market ripping higher, right? Now, sentiment gauges from GS, that's the other chart here. They look at various sentiment metrics. where they were a month ago are the orange dots, where they are now are the light blue dots. So clearly sentiment has improved quite a bit since a month ago. And everyone's talking about the melt up, right? And whilst we do understand the arguments for the melt up from the CTA positioning argument, the corporate buybacks, I mean, these are, fairly price insensitive, systematic buyers coming to the market who are going to absorb any sellers. So you do need a marginal seller to get this market down. But in terms of the Fed, we expect the Fed to stand firm and not invite markets to rally. Because if markets rally too hard, that will loosen financial conditions further and make their job of fighting inflation that much harder. We also saw recent JOLTS data and inflation expectation numbers that do not support a dovish tilt from the Fed. So I do expect the Fed to stand firm on their message. And therefore, at the margin, I think the markets probably do come back down. Now, do they come back down that violently? Probably not. The price action has shown us that people kind of are positioned for them to come back down. But in terms of whether we get enough to fuel a squeeze from what they say, I doubt we do. But stranger things have happened, so you kind of need to be careful anyway. And on that point, if you are positioned bearishly, what can you do about it? So if we squeeze, and that moves me on to my next point, I think the Nasdaq is going to squeeze hard, right? So if we were to get some sort of dovish message, if the market did start to rally, S&P could be up maybe 3%. So, was that a bit over 100, 120 points or something? But I think the Nasdaq may well be up 4 to 5% because given its recent underperformance, if we did see the sort of move in yields and rate expectations to come back down, then I think the Nasdaq could really fly because it's been a dog lately. If we look at the skew in the Nasdaq, it is similar to S&P, where it's kind of at the lows. So that's the skew on the Nasdaq. This is our vol dashboard for the Nasdaq specifically. If we look at the daily moves over the last couple of weeks, you can see there's a lot of 2%, 3% up days here, whereas the down days are a bit more minimal. So it shows you in terms of the realized moves that we're getting in the index, the up moves are being more violent than the down moves. So that makes sense as to why skew is repricing, because we're also seeing it in the price action. Implied vols have obviously come down a bit from their highs. So that was where they were at the highs. That's where they are now. But in terms of the range over the last year and a half, implied vols are still pretty expensive up here at 30, whereas, they easily could go down another 5 points or so. And then lastly, if we look at our skew scatter graph, which is this one that shows you kind of what the surface looks like right now, and that's the green line here, we can see the upside volatility right now is priced about as high as it's been. So that the kind of 10, 20% upside strikes on the Nasdaq have not really been priced at these vols, for quite some time. So even though implied vols have come down on the put side and at the monies, and they've been coming down here, these call vols have actually been rising because that skew has been flattening. So we don't really like buying a load of upside calls in Nasdaq or S&P for that matter, because those vols are trading relatively expensive to where they would normally trade, because everyone's piling into them because they're scared of the melt up. Okay, so then what would you do if you wanted to hedge yourself? If you're bearishly positioned, you're short the market, or you're underweight, you're long a load of cash, rather than doing bullish 25 delta risk reversals or buying these upside calls that to me look quite expensive, is there anything else you can do? And that's the trade idea we're going to discuss now. That's it for today. Thanks for listening, guys, and I'll catch you all tomorrow.